They had not one, but two Nobel Prize winners on their team. These were the people who literally wrote the textbooks on options pricing and risk management. If anyone could use leverage safely, you would think it would be them. But then Russia defaulted on its debt. Markets panicked. And suddenly, all of those brilliant equations and all of that sophisticated mathematics meant absolutely nothing. The fund collapsed so spectacularly that the Federal Reserve had to organize a bailout. Now, I have to ask you, if people with Nobel Prizes and decades of experience could not use leverage safely, what makes anyone think they can? I need to warn you about something that is destroying investors right now, even smart ones. It is called leverage, borrowed money. And I have watched it ruin more intelligent people than just about anything else in my 70 years of investing. Today, I am going to show you exactly why using debt to invest is one of the fastest ways to lose everything you have worked for, why even Nobel Prize winners have been wiped out by it, and most importantly, what you should do instead to actually build lasting wealth. Because here is the truth. You do not need leverage to get rich. You just need patience and discipline. Let me explain. Well, hello there. Thank you for joining me today. You know, I have been thinking about something that has bothered me for quite some time now. It is a topic that comes up again and again, especially when markets are hot and everyone seems to be making easy money. That topic is leverage, borrowed money, debt used to amplify returns. Now, I know that sounds exciting to a lot of folks. The idea that you can take $1 and turn it into the purchasing power of $2 or $5 or even $10. It sounds like magic, does it not? It sounds like the secret that the wealthy must be using. And I will tell you right now, it is not magic. It is danger, pure and simple danger. I have seen more people with high IQs do absolutely foolish things with borrowed money than just about anything else in investing. Smart people, educated people, people who could do complex mathematics in their heads. And yet, they all made the same fundamental error. They forgot that leverage magnifies everything. It magnifies your gains, yes, but it also magnifies your losses. And more importantly, it introduces something into the equation that can destroy you no matter how right you are about the fundamentals. That something is timing. Let me tell you a story. Back in 1998, there was a hedge fund called Long-Term Capital Management. You may have heard of it. This fund was run by some of the smartest people on Wall Street. I mean, truly brilliant individuals. They had not one, but two Nobel Prize winners on their team. These were the people who literally wrote the textbooks on options pricing and risk management. If anyone could use leverage safely, you would think it would be them. And for a while, it worked beautifully. They were making returns that made everyone else jealous. They were levered something like 25 to 1, maybe even higher. That means for every dollar of their own money, they were borrowing $25. When things went their way, even a small move in the market made them fortunes. But then something happened that their models did not predict. Russia defaulted on its debt. Markets panicked. And suddenly, all of those brilliant equations and all of that sophisticated mathematics meant absolutely nothing. The fund collapsed. It collapsed so spectacularly that the Federal Reserve had to organize a bailout because the fund was so large and so interconnected that its failure threatened the entire financial system. Now, I have to ask you, if people with Nobel Prizes and decades of experience could not use leverage safely, what makes anyone think they can? You see, the problem with borrowed money is not just that it magnifies losses. The problem is that it puts a time limit on being right. In investing, you can have the correct analysis. You can understand a business better than anyone else. You can know with certainty that a stock is undervalued. But if you are using leverage, None of that matters if the market goes against you in the short term, because when you borrow money, someone else gets to decide when you have to pay it back or put up more collateral. That someone is not concerned with whether you are right in the long run. They are concerned with their money right now. Let me explain this another way. Imagine you own a wonderful farm. This farm produces crops every single year. It feeds your family. It generates income. You know this farm, you understand it, and you know it is valuable. Now imagine someone offers to lend you money using that farm as collateral. They say, we will lend you money, but if the appraised value of your farm drops by 30%, you have to pay us back immediately, or we take the farm. Would you take that deal? I certainly hope not, because the value of a farm can fluctuate for all sorts of reasons that have nothing to do with its ability to produce crops. Maybe there is a drought one year and people think farms are worth less. Maybe commodity prices drop temporarily. Maybe there is a recession and people are not buying land. None of those things change the fundamental fact that your farm will keep producing crops year after year. But if you took that loan, you could lose your farm not because it stopped working, but because someone else decided its paper value dropped too much at an inconvenient moment. That is what leverage does to your investments. Now, let us talk about the mathematics for a moment, because I think a lot of people do not truly understand what happens when you use leverage and things go wrong. If you invest $100 of your own money and the investment drops by 50%, you have lost $50. That is painful, no question about it. But you still have $50 left. You still have half of your capital. And if that investment doubles from where it is now, you are back to even. A 100% gain gets you back to where you started. That is the mathematics of investing with your own money. But now let us say you took that same $100 and you borrowed another $100. Now you have $200 invested, but only $100 of it is actually yours. The investment drops by 50%. What happens? Well, that $200 investment is now worth $100. But you still owe $100 to whoever lent you the money. So when you pay them back, you are left with zero. You have been completely wiped out by a 50% decline. And that, my friends, is being generous. Because in reality, you will not get to wait until the investment is down 50%. The person who lent you the money, whether it is a broker or a bank, they are going to want their money back much sooner than that. They are going to issue what is called a margin call. They are going to say, put up more money right now or we are selling your positions. And they are going to do this at exactly the worst possible time, when prices are low and when you can least afford it. So not only does leverage amplify your losses, it also forces you to realize those losses at the worst possible moment. You do not get to wait for the recovery. You do not get to be patient. You have to sell when the market says sell, not when you think it is the right time. I have said before, and I will say it again, you should never risk what you have and need for what you do not have and do not need. That is the essence of the whole thing. If you have a comfortable life, if you have enough money to take care of yourself and your family, why would you ever borrow money to try to make more? What are you going to buy with that extra money that is worth risking everything you already have? I have been lucky in my life. I have made a good living investing, but I will tell you something that might surprise people. I have never used significant leverage. Not in my personal account, not at Berkshire Hathaway. We have always operated with the idea that we want to be in a position where we do not have to worry about what the market does tomorrow or next week or next year. We want to be able to think clearly and act rationally, and you simply cannot do that if you are worried about margin calls and lenders demanding their money back. There is a famous saying, the market can remain irrational longer than you can remain solvent. Do you know who said that? John Maynard Keynes, one of the greatest economic minds of the 20th century. And he learned this lesson the hard way. Even Keynes with all of his brilliance, got into trouble early in his investing career because he used leverage. He learned eventually, but it was an expensive education. The problem is that people look at leverage during good times and they think it is a shortcut to wealth. They see someone who borrowed money, invested it, and made a fortune when the market went up. And they think, well, if I had done that, I would be rich too. What they do not see are the hundreds of other people who tried the exact same thing and got completely wiped out when the market went the other way. It is survivorship bias, plain and simple. You only hear about the winners. The losers do not write books or give interviews. They are too busy trying to rebuild their lives after losing everything. And here is something else people do not think about. Even when leverage works, it changes your behavior in terrible ways. When you are investing with borrowed money, you cannot think clearly. You are constantly worried about the next margin call. You are watching the market every single day, every single hour. You make emotional decisions. You sell good investments at the wrong time because you are scared. You hold on to bad investments because you are hoping they will bounce back and save you. Leverage turns investing, which should be a calm and rational process, into a form of gambling where your emotions are running the show. And I can tell you from decades of experience, emotion is the enemy of good investment returns. You know, I think it is important to understand why people are so drawn to leverage in the first place. Because if you understand the psychology, you can protect yourself from making the same mistakes. The appeal of leverage is simple. It promises faster results. And we live in a world that worships speed. Everyone wants to get rich quick. No one wants to hear that building wealth takes time, patience, and discipline. That is boring. That does not make for exciting television or viral social media posts. But let me tell you something about getting rich quick. It is usually followed by getting poor quicker. I have been investing for more than 70 years now. And in all that time, I have never met anyone who built lasting wealth using borrowed money. Not one person. Oh, sure. I have met people who made a fortune with leverage for a few years. But then I checked back in with them a decade later, and more often than not, they have lost it all. Or they are still wealthy. But it is because they eventually stopped using leverage and started investing sensibly. The people who have truly built enduring wealth, the families that have stayed wealthy for generations, they did it slowly and steadily with their own money. They compounded their capital over long periods of time. They did not swing for the fences on every pitch. They waited for the perfect pitch, and then they hit it hard. But they did it without risking everything. Let me give you another historical example. In the 1,920 seconds, there was a massive bull market in the United States. People were making fortunes in the stock market. And just like today, brokers were more than happy to lend people money to buy stocks. You could buy stocks with just 10% down. That means you could control $100 worth of stock with just $10 of your own money, 10-to-1 leverage. People thought they had discovered the secret to unlimited wealth. Farmers borrowed against their land to buy stocks. Doctors and lawyers borrowed money to invest. Even people who had never invested before were taking out loans to get in on the action. Everyone was going to be rich. And then 1,929 happened. The market crashed. And all of those people who were leveraged, they got wiped out. Not just their investment gains, but their original capital too. People lost their farms, their businesses, their homes. Some people lost everything they had worked their entire lives to build, all because they borrowed money to try to make a little bit more. Now, you might say, well, that was a long time ago. We have better regulations now. We have circuit breakers and safety measures, and that is true to some extent. But human nature has not changed one bit. The desire to get rich quick is just as strong today as it was in 1929, and leverage is just as dangerous. In fact, I would argue it is more dangerous today because it is easier to access. You do not have to go to a bank and convince a loan officer anymore. You can borrow money with a few clicks on your phone. There are apps and platforms that will lend you money to trade stocks, options, cryptocurrency, anything you want. They make it seem safe and easy. They show you calculators that demonstrate how much money you could make. But they do not show you the calculator that demonstrates how quickly you could lose everything. And the thing is, the people lending you this money, they are not doing it out of the goodness of their hearts. They are doing it because they make money from you whether you win or lose. They charge you interest. They charge you fees. They make money on every trade you make. So they have every incentive to encourage you to borrow more and trade more, regardless of whether it is in your best interest. It reminds me of something my mentor, Ben Graham, used to say. He said, "The stock market is a wonderful servant, but a terrible master." The same is true of leverage, used in very specific circumstances by people who truly understand it and can afford to lose. Maybe it has a place. But for 99% of investors, it is simply a way to turn a manageable loss into a catastrophic one. I have always believed that investing should let you sleep well at night. If you are lying awake worrying about margin calls or whether you will be able to pay back a loan, you are doing it wrong. Investing should compound your wealth over time, not compound your stress and anxiety. Now, let me address something that I hear quite often from people who defend the use of leverage. They say, "But Warren, I am different. I am disciplined. I have stop losses in place. I have a system. I know when to get out." And to that I say, famous last words. You see, everyone thinks they are disciplined until the market tests them. Everyone has a plan until they are actually losing money. It is easy to say you will cut your losses when everything is theoretical. It is much harder to do it when it is your actual money disappearing before your eyes. There is something that happens to the human brain when we are losing money. We become irrational. We start to justify holding on just a little bit longer. We tell ourselves the market is wrong and we are right. We convince ourselves that if we just wait one more day, one more week, everything will turn around. This is not a character flaw. This is human nature. Psychologists call it loss aversion. We feel the pain of losses much more intensely than we feel the pleasure of gains. And when you add leverage into this equation, this psychological tendency becomes absolutely lethal. Because now you are not just dealing with the pain of losing your own money, you are dealing with the panic of owing money to someone else. You are dealing with the fear of getting a margin call. You are dealing with the stress of watching your account balance drop towards zero. I have seen brilliant investors, people with decades of experience, make terrible decisions under this kind of pressure. I have seen them sell their best investments to meet margin calls, holding on to their worst investments because they could not bear to realize the loss. I have seen them double down on losing positions, borrowing even more money because they were so certain they were right. And I have seen them lose everything because they could not accept that the market did not care about their analysis or their certainty. Let me tell you about a fellow I knew years ago. Very smart guy. He had made a lot of money in his business, and he decided he wanted to make even more in the stock market. He studied investing, read all the right books, understood value investing. He found a company that was genuinely undervalued. I mean, this thing was trading for less than the cash on its balance sheet. It was a no-brainer, right? So what did he do? He bought as much as he could with his own money, and then he borrowed more money to buy even more. He was absolutely convinced he was right. And you know what? He was right. The company was undervalued. But here's what he did not count on. It took 3 years for the market to recognize that value. 3 years. In the meantime, the stock went down. Not because anything was wrong with the company, but just because the market was not interested in that particular stock at that particular time. And after about 6 months of watching the stock go down while paying interest on his borrowed money, he got a margin call. He had to sell. He sold at a loss. And then, of course, 2 years later, the stock tripled. The investment thesis was correct. The analysis was sound. But the leverage made it impossible for him to wait for the market to come around. That is what I mean when I say leverage introduces timing risk. In investing, if you are patient enough and you have done your homework, you can usually wait out the market. Value gets recognized eventually. But if you are using borrowed money, you do not have the luxury of patience. Someone else is controlling your timeline. And here is another thing people do not think about. Leverage does not just affect your financial situation. It affects your entire life. When you owe money, it weighs on you. It affects your relationships. It affects your health. It affects your ability to think clearly about anything, not just investing. I have always believed that the most important thing in life is independence. And by independence, I do not mean having a lot of money. I mean not being dependent on others, not being at the mercy of lenders or creditors or the whims of the market. When you borrow money to invest, you give up your independence. You put yourself at the mercy of others, and that is a terrible position to be in. You know, Charlie Munger, my longtime business partner, he used to say that the first rule of compounding is to never interrupt it unnecessarily. And leverage is one of the best ways to interrupt compounding. Because when you use leverage and things go wrong, you do not just stop compounding, you go backwards. You lose not only your gains, but your principal. And then you have to spend years just getting back to where you started. Let me share with you some simple mathematics that I think everyone should understand before they ever consider using leverage. Compound interest is the most powerful force in investing. Albert Einstein supposedly called it the eighth wonder of the world. Now, I do not know if he actually said that, but it is true nonetheless. When you can compound your money over long periods of time without interruption, the results are extraordinary. Let us say you start with $10,000 and you can earn 10% a year on average. Nothing fancy, just 10%. In 10 years, you will have about $26,000. In 20 years, you will have $67,000. In 30 years, you will have $174,000. And in 40 years, you will have $452,000. That is from just $10,000 earning a reasonable return and never touching it. Now, that might not sound exciting to some people. It is not flashy. You are not going to get rich overnight. But here's the thing. It is almost certain if you invest in good businesses at reasonable prices and you leave the money alone, that compounding will happen. It has happened for over a century. It will keep happening. But now let us introduce leverage into this picture. Let us say instead of investing just your $10,000, you borrow another $10,000. Now you have $20,000 invested. If things go well and you earn that same 10%, you make $2,000 instead of $1,000 in the first year. But you have to pay interest on that borrowed $10,000. Let us say the interest is 5%. That is $500. So your net gain is $1,500 instead of $1,000. You made an extra 50% profit. That sounds great, right? But what happens if the market goes down? What if instead of going up 10%, your investment goes down 10% in that first year? Well, now your $20,000 investment is worth $18,000. You lost $2,000, but you still have to pay that $500 in interest, so you are down $2,500. And remember, you only put in $10,000 of your own money. So you have lost 25% of your capital in 1 year, even though the market only went down 10%. And that is assuming you do not get a margin call. That is assuming your broker lets you hold on through that decline. In reality, they probably will not. They will force you to sell at exactly the wrong time. Do you see how the mathematics work against you? Leverage amplifies your losses more than it amplifies your gains, because you have to pay interest regardless of what happens. And that interest compounds against you just as surely as investment returns compound for you. Now, some people will say, but Warren, what about using leverage to invest in sure things? What about borrowing money to buy treasury bonds that are guaranteed by the government? And I will tell you, even that is risky, because even though the bonds themselves might be safe, the price of those bonds can fluctuate. If interest rates go up, the price of your bonds goes down. And if you are levered, you could still face a margin call even though you are holding theoretically safe investments. This actually happened to some very sophisticated investors during the bond market volatility we have seen in recent years. They thought they were being smart by leveraging safe government bonds, but when rates moved against them, they still lost money, they still faced margin calls, they still had to sell at losses. The lesson here is simple. There is no such thing as a sure thing when you are using borrowed money. The act of borrowing itself introduces risk, regardless of what you are investing in. I want to tell you about another principle that has guided me throughout my career. I call it the margin of safety. The idea is that when you are investing, you should always have a cushion. You should buy things that are so undervalued, so cheap relative to their true worth, that even if you are somewhat wrong in your analysis, you will still do okay. Benjamin Graham, my teacher, he taught me this principle. He would say that you should never buy a stock unless it is trading at a significant discount to what you think it is worth. Maybe you think a company is worth $100 a share. Well, you should not buy it for $95. You should wait until you can buy it for $60 or $70. That way, even if you are wrong about the value, even if it is only worth $80 instead of $100, you still have not lost money. This margin of safety is your protection against uncertainty, against bad luck, against your own mistakes. It is what allows you to sleep well at night. But leverage completely destroys your margin of safety. When you borrow money to invest, you have no cushion. Every dollar you lose is magnified. There is no room for error. Now, I want to address something specific because I know a lot of people will be thinking it. They will say, but Warren, what about real estate? Everyone borrows money to buy real estate. Are you saying that is wrong too? Well, let me be clear about something. There is a difference between borrowing money to buy a home that you are going to live in and borrowing money to speculate on investments. When you buy a home with a mortgage, you are buying something you need. You are going to live there regardless of what happens to the price. You are not going to get a margin call on your house as long as you can make the monthly payments. That is a very different situation. But when people start using leverage to buy investment properties, or worse, to flip houses, now we are back in dangerous territory because those properties are not producing income that covers the debt service. Those properties are speculations on price appreciation. And anytime you are speculating with borrowed money, you are playing with fire. I saw this happen in a big way during the housing bubble in the mid-2000s. People were buying multiple properties with little or no money down. They were taking out adjustable rate mortgages with teaser rates. They were borrowing against the equity in their homes to buy more properties. And for a while, it worked. Prices kept going up. Everyone was making money. But then prices stopped going up, and then they started going down. And all of those people who were leveraged, they could not afford to make the payments anymore. They could not sell the properties because they owed more than the properties were worth. They lost everything. And their foreclosures contributed to even more price declines, which hurt even more people. It was a vicious cycle, all caused by too much leverage. The same principle applies whether you are borrowing money to buy stocks, bonds, real estate, or anything else. If you cannot afford to own it outright, or if you cannot afford to make the payments from the income it produces, then you are speculating. And speculation with borrowed money is a recipe for disaster. Now, let me talk about something that particularly bothers me about the current environment. We have social media now. We have YouTube and Twitter and Reddit and all of these platforms where people are constantly talking about investing. And a lot of what I see on these platforms is frankly terrifying. You have young people, sometimes very young people, who are being told that the way to get rich is to use maximum leverage. They are being shown screenshots of brokerage accounts where someone turned a small amount of money into a fortune using options or margin or some other form of leverage. And they think, well, if that person can do it, why cannot I? What they do not see is that for every one of those success stories, there are 1,000 failures. They do not see the people who lost everything trying the same strategy. They do not see the depression, the ruined relationships, the broken lives that come from gambling with borrowed money. And make no mistake, that is what it is. It is gambling. It is not investing. When you are using high levels of leverage to try to make quick profits, you are not investing in businesses. You are not becoming a part owner of wonderful companies. You are just gambling on short-term price movements. And the odds are stacked against you. The platforms that allow this behavior, they are not helping people. They are profiting from people. Every time someone makes a leverage trade, the platform makes money. Every time someone pays margin interest, the platform makes money. They have gamified investing, turned it into something that looks like a video game or a sports betting app. They send you notifications. They show you leaderboards. They encourage you to trade more and borrow more. But this is not a game. This is real money. These are real lives. And when people lose, they do not just lose points or get to start over. They lose money they cannot afford to lose. Sometimes they lose money they borrowed from family members. Sometimes they lose their life savings. I think it is particularly cruel because the people who are most vulnerable to this are often young people who do not have a lot of money to begin with. They are looking for a shortcut. They are told that investing the traditional way, saving money and compounding it over time, that is for suckers. That is too slow. They are told they need to use leverage to catch up, to get ahead. But it is a lie. The people selling them this dream, they are already ahead. They already have money. They make money whether you win or lose. You are not playing with them. You are playing against them. So let me talk about what you should do instead. Because I do not want to just tell you what not to do. I want to give you a path forward that actually works. The first thing you need to do is change your expectations. You need to accept that building wealth takes time. There is no shortcut. There is no secret. The people who are truly wealthy, the people who have financial security that lasts, they got there slowly and steadily. I started investing when I was 11 years old. I am now in my 90s. That is more than 80 years of compounding. And you know what? Most of my wealth was built in the last few decades of that period. That is how compounding works. It starts slow. It feels like nothing is happening. But if you stick with it, if you do not interrupt it, it becomes powerful beyond belief. Now, I am not saying you need to invest for 80 years, but I am saying you need patience. You need to think in terms of decades, not days or months or even years. If you are young and you are just starting out, that is wonderful. You have the most valuable asset of all, which is time. Do not waste it by trying to get rich quick. Use it to get rich slowly and surely. Here is what I recommend. Take whatever money you can afford to invest, money you will not need for at least 5 years, preferably longer. Invest it in a diversified portfolio of good businesses If you do not know how to pick individual stocks, that is fine. Buy a low-cost index fund that tracks the overall market, and then leave it alone. Do not check it every day. Do not panic when it goes down. Do not get greedy when it goes up. Just let it compound. Add to it regularly if you can. Even small amounts make a difference over time. But do not touch it. Do not try to time the market. Do not try to get fancy with leverage or options or any other complicated strategies. Just be patient. Let time do the work for you. I know that sounds boring. I know it does not sound exciting. But you know what is exciting? Having financial security. Being able to retire comfortably. Being able to help your children or grandchildren. Being able to sleep well at night knowing you are not going to lose everything because the market had a bad day. That is what investing should give you. Not thrills, not excitement, but security and peace of mind. Now, let me tell you about something else that is important. You need to live below your means. I know that is not what people want to hear. We live in a culture that encourages spending. That encourages showing off. That tells you that you need the newest phone, the fanciest car, the biggest house. But here is the truth. The more you spend, the less you have to invest. And the less you have to invest, the longer it takes to build wealth. It is simple mathematics. I still live in the same house I bought in 1958. It is a nice house. It is comfortable. But it is not a mansion. It is not trying to impress anyone. And you know what? I have never regretted that choice. Not once. Because that choice, along with thousands of other choices to live modestly, allowed me to invest more money. And that invested money compounded over decades into real wealth. I am not saying you should deprive yourself. I am not saying you should not enjoy your life. But I am saying you should be thoughtful about what you really need versus what you think you need, because society tells you so. Every dollar you save is a dollar you can invest. Every dollar you invest is a dollar that can compound over time. And if you never interrupt that compounding, if you never take on leverage that could wipe you out, the results will take care of themselves. Let me share one more story with you. I have a friend who started investing in his 20s. He was not making a lot of money. He was a school teacher, but he was disciplined. He saved 15% of every paycheck. He invested it in a simple portfolio of index funds. He never tried to time the market. He never used leverage. He just kept doing it. Year after year, decade after decade. When he retired at 65, do you know how much he had? Over $2 million from a teacher's salary. No leverage, no fancy strategies, just patience and discipline. That is the power of compounding when you do not interrupt it. That is what is available to anyone who is willing to be patient and disciplined. But you have to resist the temptation of leverage. You have to resist the siren song of easy money, because every time you borrow money to invest, you are risking all of that compounding. You are risking your future for a chance at getting there a little bit faster, and the mathematics just do not support it. The risk is not worth the potential reward, not when you have time on your side. You know, I want to leave you with a few final thoughts before we wrap up today. I have been asked many times over the years what my biggest investment mistakes have been. And I have made plenty of mistakes, believe me. I have bought businesses I should not have bought. I have held on to investments too long. I have missed opportunities I should have seen. But you know what mistake I have never made? I have never bet the ranch. I have never put myself in a position where a single bad outcome could wipe me out. I have never used so much leverage that I could not sleep at night. And that is why I am still here, still investing, still compounding after all these decades. The people who blow up, the people who lose everything, they are almost always using too much leverage. It does not matter how smart they are. It does not matter how right their analysis is. If they are using borrowed money, they are one bad break away from disaster. And the thing is, bad breaks happen. They happen to everyone. Markets crash, recessions occur, unexpected events disrupt even the best laid plans. If you are not using leverage, these events are just bumps in the road. You can wait them out. You can even take advantage of them by buying more when prices are low. But if you are using leverage, these events can be fatal. They can end your investing career before it really gets started. They can take decades of hard work and wipe it out in a matter of days or weeks. So my advice to you is simple. Do not use leverage. I do not care how good the opportunity looks. I do not care how certain you are. I do not care what your friend or your brother-in-law or some person on the internet says. Do not borrow money to invest. Invest what you have. Be patient. Let compounding do its work. And protect your capital above all else. I want you to remember something that Charlie Munger used to say. He said there are 3 things that can ruin you in this life: ladies, liquor, and leverage. Now, I will not get into the first 2, but that third one, leverage, that is the one that ruins investors. That is the one that takes smart, capable people and leaves them broke. You do not need leverage to build wealth. You really do not. What you need is patience, discipline, and the willingness to think long term. Those 3 things, combined with regular savings and sensible investments, will get you where you want to go. It might take longer than you would like. It might not be as exciting as watching your account balance swing wildly every day, but you will get there. And when you do, you will have something that the leverage users will never have: security, real lasting security that cannot be taken away by a margin call or a market crash. I have seen too many people ruin their lives with borrowed money. I have seen marriages destroyed. I have seen retirements postponed indefinitely. I have seen young people with so much potential give up on investing entirely because their first experience was a leveraged disaster that wiped them out. It breaks my heart every time I see it because it is so unnecessary. All of that pain and suffering, all of those ruined lives could have been avoided with one simple decision: the decision not to borrow money to invest. So please, I am asking you, as someone who has been doing this for a very long time, as someone who has seen it all, do not use leverage. It is not worth it. It has never been worth it, and it will never be worth it. There is an old saying, those who do not learn from history are doomed to repeat it. Well, the history of leverage and investing is clear. It ends badly far more often than it ends well. Learn from the mistakes of others. Do not insist on making those mistakes yourself. Your future self will thank you. Your family will thank you. And you will be able to sleep well at night, which is worth more than any investment return. I want to thank you for spending this time with me today. I know I can be a bit repetitive on this subject, but it is because I care. It is because I have seen too much unnecessary pain caused by leverage. And if I can convince even one person to avoid that mistake, then this time has been well spent. Remember, invest with your own money. Be patient. Let compounding work its magic. And above all, never risk what you have and need for what you do not have and do not need. That is the secret. It is not exciting. It is not complicated, but it works. It has worked for over a century, and it will keep working for anyone who has the wisdom to follow it. Thank you for listening. Take care of yourselves and take care of your money. Do not let leverage take care of it for you.